Hello folks, I'm L.A. Little, and this is your daily NeoTA wrap. We take a look at these markets, and we do it from a neoclassical perspective each time, asking ourselves what happened today, and what does it tell us about the coming ones. We do the show 4 times a week, every Monday through Thursday, broadcast at or before 10 o'clock Eastern Time and archived on YouTube. It's under the channel L.A. Little. It's October 30th, another month just about gone, and what a month it's been. If we look at the numbers today, there was no sell the news. I guess that would be kind of a summary of what happened today. We had some GDP numbers out. They look pretty good, and this market just walks higher. It seems to have no problem scaling any and all concerns all the way up. We had some pressure in technology, right? And it was a battle early. But Visa was in the Dow, took it higher. It was the one leading the way. The Russell finally kicked in and got up almost 1%. S&P's up a little over 0.5%. S&P's almost back to the highs. When we look at the charts here, you're going to see almost all of these back to highs. It's a pretty amazing sight. 10 days of straight up, all the losses are basically wiped out at this point, and you're back up where you were. Dollar, strong again today. What does that mean? That means all your commodities pretty much go down the drain. Bonds a little bit higher, not much, and that's pretty much the story. So, when you're looking at the indexes, it's kind of an amazing story that just continues to play out, in that everything and anything is another reason seemingly to buy. Dow Jones, if you remember last night, was the only one giving us a signal on the indexes that we were probably going to try to pull back, at least here. Well, today we get earnings out of Visa, and it's the one that leads us all the way up. Visa, Dow is a weighted index, price weighted. So Visa, being a very high price, carries a big move in the Dow, and that pressured it all day long. Now, some are going to tell you, and it's true, that there was some under the cover action that was a little bit disturbing tonight, but it doesn't matter when these indexes are going. Most everything gets pulled with them, and that's what's happening. Remember, we had some retest regenerates on breaks of the highs. This one's breaking a high tonight, actually breaking 2 of them. Going to flip around just like the rest and go bullish. All the indexes are bullish again on the short-term time frame, and they're all going to be bullish if they can hold their horses for another day without going over the highs. Then next week they have the potential to go back to bullish on the intermediate term time frame. The only concern now, if you're a bull, is that you're going to get up there and get over these highs before the week is out. And at the rate it's been going, that may be true. And the problem with that is you don't have 6 bars yet to make it a swing point high, so you wouldn't even get a change in trend. And these vertical moves sometimes do that. But, I doubt it's going to do it tomorrow, but then I doubted it was going to do what it's already done, which is vastly power higher day after day after day on absolutely no volume as usual. Looking at the top here, and you're going to see this in almost all of them now. If you take that high volume bar, and it's kind of hard to believe, but probably 3-4 weeks ago we were talking about that bar would probably get tested again, right? Because we had those high volume bars right across the board. That high volume bar was back on the 19th. Volume there huge, but the price point is 17,257.46 is the low. You missed it by about 20-30 points. These all look like they're going to try to get into at least the lows of the highs at this point. That's here. It's also in the S&P 500. The low there is 2,659. We got about 2,000 today, 1999. So you're 6 points away, and we're doing 20-30 point clips day after day anymore. So you could easily get up there and get into it. You're already there on the NASDAQ, right? It's into the bar. Of course, the volume's not there, but it's into the bar. And the NDX was into it 3 days past, still into it, going sideways. This one's kind of consolidating while everything else starts to catch up. This had been the strongest one. And then the Russell, of course, is just catching up, and it's got a ways to go to get back up to the high. It's going to try to get over this bar first, which is the 1163 number. But any way you look at this, folks, it's been an amazing run, and it continues. And each time it's done this, for example, you can keep drawing these as we go. I don't keep bringing them up every night, but here was another ABCD structure, just like we had before. This one's overextended already as well. We had one off the lows that was already finished, right? So, time after time, these things are going and they're extending past where you would expect them to go. It's just how strong this market has been and continues to be. There's really, no words to describe it anymore. It's just, day after day of, higher and higher. And there is nothing in these indexes as of tonight, to tell us there's any kind of pullback even coming yet. Now in the sectors, it's a little bit different in that you have some really strong ones and some weak ones. IBB, remember last night, that one was going to try to pull back. Well, new highs today. Now the IYT actually did pull back, and this is the first one now to fail to hold a swing point high. Now, of course, it had broken 3 on the way up, so I don't know that this is any kind of a major failure, but you did get back underneath it, stayed underneath it. That says that, okay, we were trying to retest regen bullishly and did not succeed. We failed. So if it stays down here another bar tomorrow, that would be kind of a cement on that failure and say, okay, that's a range trade. We've been talking about a range trade, and I'm starting to not talk about it because, we're starting to make new highs. I mean, we made new highs here. We made new highs in the IBB we just looked at. We've made new highs elsewhere, the XLV, XLP, XLU. I mean, I can go down the board, and we've got new highs all over the place. So, this whole idea of a range trade, boy, it looked good about a week ago, but anymore, the whole idea is kind of stretched. But IYT, first one to come back in, suggests it's going to try to range trade for a while. SOX, remember the SOX had gotten over swing point low, bullish, the bearish retest regenerate had failed. It pulls back in a little bit today, but even it wouldn't stay down today, despite some serious selling in some of the names, the big names in it. For example, Intel, which took a big hit. So, maybe the SOX is going to try to pull in a little bit, but it's not quite clear. XLB held the retest regen off this big swing point. So there's a big wide price spread swing point bar here. It goes from there to there. It's testing down here, and it does hold and bounces off today. So XLB did hold. Still wants to regenerate higher. XLF also pressing. It's over another high, going for the all-time highs up there. Not all-time, but the highs of the year. XLE can't get started. XLI over the highs as well, are actually testing the highs. And actually, it's basically a failure. Went over back under the prior day, so it's like a 2-bar reversal, but we've seen how well that worked out lately. The problem is at this point, you look at these little reversal here signal or something over there, but the vast majority of these aren't given the signals. Now usually you'll get 2 or 3 and then 3 or 4 and then you got something. Well, IBB should have tried to pull back, new highs. IYT should have pulled back, did. Dow Jones should have pulled back, goes to, it leads the market up. So you can't, I can't put a lot of weight in what we see as to being maybe about 3 signals here on the sectors suggesting some sort of a pullback. The other thing that's fascinating is the safety sectors are just powering ahead. XLU, XLP. I mean, these are where people put their money when they're a little worried, versus like the IBB where you put it when you want to be risky. So maybe the whole ideal here is you just put it, and you put it in both cases, and maybe that's kind of the portfolio theory nowadays, and we'll get to that here in a little bit later in the show. But You know, usually you pick non-correlated instruments. Well, maybe that's non-correlated, right? Risky versus safe stocks. I don't know. Everything's correlated anymore, it seems. So I'm kind of worried about the whole idea of portfolio theory, and we'll talk about that as part of the spotlight tonight. Okay, overseas. Really nothing different there. You know, you had some weakness coming in. We saw it in Europe this morning. Here's the CACs. Was pushing down this morning. Of course, our markets just took off, flipped them around. By the time they closed, they're up there doing dojis at the highs. And big volume testing on the way down, so I wouldn't be surprised to see it come right back the other way. Same thing on the DAX. So Europe tried to trade lower, but our juicing of the markets turned them around. Over in Asia, Hong Kong, Hang Seng, they did the same thing, right? The H-cap shares for China, the Hong Kong, really couldn't get going. Most of the others, other than India, can't get going. And Japan. Japan continues to find a way by buying more stocks with their pension funds and devaluing their currency. Speaking of the currencies, the dollar continues to work its way higher, gapped up today, pretty much held that gap, did trade back down into the prior day, but ended up higher, closes up. It looks to me, it's over that swing point high. It looks to me like it's going to go after the highs. And commodities, where he talked about, if you look at gold and silver, these guys are down there banging on the bottoms again. They're going to test the lows again. And this will be the third time down on the weeklies. And if that breaks, folks, there's not much below it. So it might be a nasty break to the downside. Bonds, on the other hand, they were actually pushing up pretty good this morning, but gave most of it up. So bonds still not able to get going. So in a nutshell, what do we got, synopsis-wise? Despite what seems like a huge need for some sort of consolidation, I still don't see any overwhelming set of signals that suggest it's going to happen. That's even after 10 days straight up, basically, on huge percentage moves. We're talking massive. 10, 12, 13%, depending on what you're looking at. In 10 days, folks, on major indexes. I don't have any words to describe it. It's not normal. Then again, there's not a lot normal in this market, it seems. Okay, viewer questions. Actually, I didn't have any, I don't think, tonight. Let me take a look here. If you want to ask questions, just pop over to the site at the NeoTA TV and pop down here, and you can get some directions about how to do that. I know that we get new viewers nightly, so or a few straggling in here and there, so I just want to remind you. I'm quickly looking here. I don't believe there were any questions tonight. No, I don't see any. Okay, so let's pop over to kind of the special tonight, the special spotlight, where we try to spotlight. And last night I was talking about money management risk portfolio, so I thought I'd just delve into that a little bit and bend your ears with respect to this whole ideal of portfolio management. When people talk of portfolio management, they're usually talking about portfolio theory. And what that means is that you take and spread your eggs in a bunch of different baskets, or at least a few, right? And those baskets, though, they need to be non-correlated or fairly non-correlated. And historically, that's always been like bonds and equities, right? So that you'd have a mix of maybe 40% bonds, 60% equities. And you would maintain that. And maybe those equities divided into, more risky equities and more safe equities. And somehow you make that mix between that set of two non-correlated instruments. And some people mix in others, but those are the two basic ones. And I thought I would just use that as an example. And the important part here is that they are negatively correlated. In other words, if the price of one goes up, the price of the other should go down. And if you look at, and I just brought up a 20, you know, this goes back to about 10, a little over 10 years. Over the last 10 years, you could see the negative correlation. So in other words, if I zero back into maybe this part of the graph, blue being the S&P 500 and the black being the TLT bonds, right, long-term bonds. When you had the crash, there definitely was a negative correlation. Prior to it, there was some, but not huge. You know, they were both kind of drifting up, but certainly bonds were not going like stocks. If you expand this out, though, you can see that the stock market, of course, has been on this, you know, huge push higher. But at the same time, the bonds have done exactly the same thing. You know, if you just make it a trend line, you know, and draw the trend line through here, you know, it's been kind of the same thing between both of them, which is not negatively correlated. In other words, bonds should be doing something like this when stocks are doing something like that. And vice versa, when stocks just like here go this way, bonds go the other way. That's the whole point. So you buy the bonds and the stocks, and you make shifts in that allocation scheme so that when something like this happens, these keep you from going straight down in terms of your risk management. The problem now, of course, is that when you look at these, they're both doing exactly the same thing. They're not non-correlated. Now, right now, that actually works pretty well. If you have 40% bonds and you have 40 or 60% stocks, you feel like a king, right? You just keep, you know, both of them are going in your favor. Not what's supposed to happen, but what is happening. So the point here is that the dilemma for portfolio managers is what happens when these markets finally turn. Are bonds and stocks going to do the same thing? Are they both going to go down? Are bonds going to go up, or maybe are they just going to go sideways while stocks go down? You know, if they've both done this so far, it's kind of hard for me to imagine, and I think that's what most portfolio managers are struggling with. It's kind of hard for me to imagine bonds are going to go up more. I mean, interest rates are like zero. How can bonds go up? So bonds aren't going to buy you much safety in terms of return, right? If anything, they're going to go sideways. So if they're going to go sideways, why even have them? Why not just be in cash? You get the same result, and you would take the risk out of the negative case where bonds and stocks go down. Now, I can't imagine why that would happen, but then again, I'm a product of the last 30 years when they both were negatively correlated. But ever since we've got this central bank intervention, what used to be up is down, and what used to be down is up. Matter of fact, what used to be anything is up now. Everything's up except for, you know, the dollar now pushing commodities down. But when I look at this, and when other portfolio managers look at this and they're trying to do the classical thing that everybody does with portfolio theory, it's a problem. As a matter of fact, if you happen to catch this wrong, and let's say that you reallocated right here and you put on more bonds, you know, then you took this hit on your bonds even while your stocks went up. So you can see how, anyway, I guess you wouldn't have done it that way if you're really watching what you're doing. You get a pullback, you should be buying this one and selling that one, right? But, if you did it right, you probably came out ahead, which kind of brings me to the next thing, which is, everybody measures against the performance of the S&P 500. So, if you think about it and you're measuring against this blue line, are you outperforming that thing over some period of time? Now, most people measure year to year. I think that's kind of a mistake. You really want to measure over years, because what really matters is for you to keep the money when times are bad. So, example, when, the market did this, someone that could have outperformed over, this period of time, may have looked really good during this short period of time or really bad during this short period of time, but over the long period of time did. And that gets down into how much drawdowns are you willing to take. Or is it okay to take a 40% drawdown? This was 35. Is it okay to take that kind of drawdown? It actually is about 50 off the top. If it isn't, then you have to find a way to get around that, and that depends on what people are trying to do. So getting back to the point here is, like, if you're going to outperform this S&P line, most people aren't going to be 100% invested. If they are, they should just invest in the S&P and just ride it all the time, right? Be 100% invested and you perform just as well or bad as the S&P does. But most people, of course, want to try to outperform it somehow. And if you're going to do that, there's different ways to try and do it. Probably the three classical ways is that you invest with a lot of leverage, and you do it in things that will perform as well or better. And so you may, let's just say that you're, 2-to-1 leveraged most of the time. And if you can find instruments that at least make money and make, more than 50% of what the S&P does, then you will outperform it. Another way to do it is to invest fully, or even partially in other things that do better. For example, you don't buy just the broad S&P 500 stocks. You buy 10 stocks that you think will do better. And you're pretty good at picking them, and they do. And maybe you got 90% of your money in those 10 stocks. And so you ride them up and you make a lot more money. And so that's another way people do it. And the last one really is kind of that, don't take drawdowns. So anyone that is able to miss this move and at least go sideways here, right? They've got a huge jump on everybody else. And so, if they're able to go sideways and they start back up from this point, the angle of their ascent can be a lot different than the angle of this ascent, and they still come out ahead. So, that's kind of the other way, is don't take the drawdowns. Now, note, if you do the first thing, and that is you use the leverage, you're going to take a lot greater risk. And if you try to outpick the market, you got to be a pretty good stock picker or an instrument picker. Maybe you're, trading currencies as well, or commodities or whatever. If you do the latter, the drawdown case, right, you got to be a good timer. So depending on what your strength is, you need to find a portfolio style that matches your strength and allows you to sleep at night. If you can sleep with a huge drawdown knowing it will eventually come back, then, more power to you. If you can't, then it's a whole different story. So if we go back to a question of portfolio theory, portfolio theory really is trying to do the last case. That is, it's trying to avoid these big drawdowns. And so the whole idea is, if you have non-correlated instruments, bonds, stocks, and you're weighted in such a way that you don't get hurt, your drawdown in the 2008 debacle may have looked like, say, that instead of this. And that's what portfolio theory tries to do for you. Now, ever since this drawdown, assuming you did that, your returns probably are better than the S&P 500 if you maintained a decent mix on the way back up, because you didn't take the difference here. You didn't take this difference in the drawdown, right? All of this you gained and is tacked on, assuming you're able to, stay with the market on the way up, or mostly. And given the way, they've been correlated, you have. The big question now, and I think everybody asks themselves, is, are these going to be correlated to the downside when and if that comes about? And I don't know the answer to that. All I know is that, if I just look at these things, I can't see how bonds are going to outperform, in other words, go up more. It'll certainly not go up that much more, probably, if the market starts to tank. There's just not much room to go up much more. Okay, Well, hopefully that's useful. And, if you got some questions, pop them over to me. It's Thursday. It's the last show of the week. You got a big scenario coming up here as the markets, just push right on up into the highs, and we'll see, what they're going to do with it. Right now, the only thing that looks to me like it actually could do something to this market is if this dollar starts to take off again. I'm sure there will be a pullback somewhere, but you got to think they're going to buy it at this point. I mean, my gosh, you just went up this much. You get a decent pullback, everybody's going to jump on it. The dollar can change the whole scenario just like it had a month and a half, 2 months ago. Have yourself a great night. Thanks for joining me. Take care. And until next time, I'm LA. This is and it was your daily NeoTA wrap. Have a great one. I'll see you next time. Good night, folks.